Hi, my name is Marc Chapman, manager of the HI European Equity Fund. Just looking at the month of May, the fund appreciated by approximately 1.5% over the period, and that was essentially driven by a few stock-specific considerations rather than any particular directional bet or theme which was playing out in the market. So I'd like to highlight one particular stock which I think is interesting, and this is Greencore, which is listed in Ireland. The company is a supplier of food to the UK food service industry. It supplies convenience foods to Marks and Spencer's and other food retailers. This is a growth segment of the market due to people having less time to spend, ordering online, and also buying more convenience food. This has been a stable, growing segment for a long time, and Greencore dominate this space. Since then, they've also expanded into the US market, initially serving 7-Eleven and Starbucks. The idea was that Starbucks would expand their food range, both at the breakfast and lunch level, and Greencore, from various facilities in the US, would supply them with fresh and frozen food. Over the past couple of years, this growth dynamic hasn't really come to fruition, and the company made an acquisition called Peacock, which is another US food supply specialist, and increased its presence in the US, but the organic growth didn't come through. This led to a profit warning earlier in the year and a large share price correction. We've owned the stock in the past, and so we re-looked at the company. Having spoken to the management a couple of times and reviewed the case, we thought the UK convenience food segment was extremely steady, and in fact organic growth would continue at 5% and the margins would be stable. In the US, because of the disturbed relationship with Starbucks, there's going to have to be some adjustment to the production footprint, which meant a shrinkage of capacity and a reallocation towards other fresh and frozen customers. Based on the pipeline of customers Greencore has in the US, we think it's likely that organic growth will resume in 2018 and 19, and that the operating margins, which have been suppressed because of low utilization, will start recovering towards 5% and further over the next few years. Now, when we looked at the valuation, given the disappointment the market had felt from the weak US performance, the share price corrected aggressively, and in fact the company valuation only reflected the UK business. The US business had essentially been eradicated from the value in the company. This was a good starting point for long, and we felt that as the market regained confidence in the growth dynamic in the US, consensus expectations could start improving again and the valuation could move back towards more fair levels. And this partially happened during the month of May. So that's one notable performer. Other notable stocks that performed well performed for specific reasons rather than the sector they were in. The negatives for the month were mainly the hedges and a couple of individual names which corrected after a strong run. Going forward, we have no strong directional view, but think that is good intrinsic value in our long book, which should help the overall NAV of the fund move towards its long-term target. Thank you very much.